I know. I didn't. It looks weird.
Hello, welcome to this week's version of Real Estate Revelations. John Edwards, Castle and Cook Mortgage.
NMLS 671258.
And Jude Sandoval, Dream Homes by Jude at Brokers Guild. Welcome. This week we are talking about interest rates. Everybody's
And there's
favorite
nothing more
thing.
interesting than interest rates.
Oh, that's
Jude.
a good one.
Yeah.
That's a good one. I'm going to put that on our
We should
tags.
keep- yes.
Wow, did you think of that all week? Because you're using that
I've-
funny
I've
one,
been-
so that
yeah.
was a good one. I think that's just basically my job. You
Yeah.
have all the knowledge and information. And I
And
just sit
you're
here.
the funny
Actually,
guy.
I was describing this week. There's somebody who was watching it, and I said, "Yeah, John just kind of gets all the stuff together, and everything." I just try to make John laugh every week and be funny.
It
And I don't know if it works.
sometimes.
Hey, it must be working. I've got 2 YouTube subscribers now.
Nice. You
Doubled.
doubled last week.
Yes.
Awesome.
I'm
Two.
on my way.
Too.
I'm on
All
my way.
right.
So this week, folks.
If you're out there, folks,
Yeah.
find Jude's YouTube channel and
Jude
sign
Sandoval,
up.
Dream
Really get him
Homes by
excited.
Jude. Let's try to double it this week to 4.
Ooh.
We'll move our way.
Okay.
And I think if I get up to 100, then I can monetize it or something and
Oh.
make some dollars.
Yeah, really start
Couple
to
dollars
Put
if
we've
people
got
keep
3 girls.
clicking in.
Someone's got to put them through
Well, hey, I
school.
gotta put, that, and I should get them their own YouTube channels because then they can subscribe to me and
Yeah,
and
that's
get me
true.
up too. So
Yeah.
Lots of ideas. So let's
We're
get
probably
into
all going to get married too, and you get to pay for that as well. So I mean, you really
okay,
anything you
okay.
can think
12,
of.
10, and 8. Let's not get too ahead of ourselves. All right.
They're awesome though. They've been helping you out so far this year, huh? Or this summer?
Well, the summer.
helping.
Yeah, they're in the office and, between doing some stuff. I try to get
Yeah.
them on the computer, and sometimes they know even more than I do. So I'm
Scary,
trying
huh?
to get stuff. Yeah, it's crazy. But anyway, if
Anyway.
you find some value in what we're doing here, some of the information that we've got, please like us, share with your friends. Also, post some comments. Actually, I'm going to get us on Facebook here, and we'll be checking for our regular audience. If you're new or watching on a replay, there should be a little section below that you can send a comment or a question through. It'll come through to us, and we'll answer that and do the best to get back to you as soon as possible. And subscribe to our YouTube channels to watch some of the past episodes as well. So with that,
All righty,
Mr.
let's get
Edwards,
started
will
and
find us here on Facebook.
talk about interest rates. So have you ever wondered how a lender determines your interest rate? Just going to talk about some of the basics in interest rates today. I'm not going to dive into a ton of detail, but I hope that you come out of this presentation understanding a little bit more about what an interest rate is and how it works. So, oops, skipped one. So what we're going to talk about today, what is an interest rate? How do you determine what the interest rate will be? How does your interest rate impact your loan? Are interest rates negotiable? And then we'll do a quick recap.
Sounds good.
So what is an interest rate? An interest rate determines the amount of interest you will pay for your loan each month. So when you buy a house, you put some money down. Let's say it costs
Hopefully.
$300,000
Mhm.
and you put $15,000 down, right?
Okay.
5%, if my
5%.
math is correct
Good
on
math.
that. So then you've
That's
got
why
a
you're the
loan
mortgage
amount
broker.
of $285,000. Now, the lenders are typically very nice people, good-looking guys, from like Denver per se.
Very generous.
And they're like, hey, we would love to help you out. However, they can't just give you $285,000
Wouldn't that be
and
great?
not get anything in return. So the way that they determine how much do you get to pay them back in return is through the interest rate. So typically what you're going to do is a 30-year fixed rate mortgage. That's the most typical mortgage. That means you're going to make 360 payments on that mortgage unless you sell the house or refinance the mortgage.
Okay.
And the interest rate is determined in the very beginning. It doesn't change unless you do an adjustable rate mortgage. The very first payment you make is going to have the most amount of interest included in it. The last payment you make is going to have the least amount of interest you pay. So every time you make a mortgage payment, you pay a little bit less in interest
And
and
when-
a little bit more
Okay.
in principal.
And when you say the most amount, meaning most dollar amount,
Most dollar amount
paying
of
that,
interest.
that interest
Yep.
part of it down first
Mhm.
before you start paying.
You
off
are paying that interest
the
portion
principal.
first. Yep.
Okay, gotcha.
You're always paying a little bit of both, but you're in the beginning, you're paying more interest. At the end, you're paying more principal. which is nice.
Because all that money you print and you send to people, you want to make your money back before the principal, right?
Yep. So the APR.
Just to be clear for everybody at Castle and Cook that are regulating and watching, Jonathan does not print his own money and lend his own money.
I do not.
We got to just be careful these days. You know, I should not joke. So
I agree. So you may have heard of an APR. An APR is really just kind of your interest rate determined on an annual basis, which includes any costs associated with the loan, versus the interest rate we just talked about, which is really just the amount that you're paying on the amount borrowed, that $285,000. Your APR is the $285,000 plus any closing costs, other costs associated with the loan from the beginning. They break it down over a 30-year period, and that's the annual amount that you would pay. So very confusing, the APR versus the interest rate. In general, your APR is going to be a little bit higher than the interest rate because it takes into consideration costs associated with the loan.
Right. And what would some of those be?
So it could be lender costs, could be title costs, county recording fees, appraisal, those kinds of things would be considered in there. At discount points, if you buy down your interest rate, that would be considered as well. So the higher, and this is a point I'm going to talk about quite a bit throughout the presentation, the higher the interest rate, the higher your payment's going to be, and the more you're going to pay in interest over the life of the loan.
All right, so that's a big, important point now.
And we're going to talk about it a few times.
With interest rates, slowly over the past couple of months, creeping up a little bit.
Really over the last couple of years. I would say a little bit more intensely over the last couple of months.
Right.
But, I think our lowest interest rates are probably 3 years ago now or so. And then just a slow increase. Trump gets elected, take a little bit of a spike. They continue to sort of slowly increase from there. And the Fed has said that they intend to raise interest rates, or they're probably going to. They're always so careful with their verbiage, but they're probably going to have at least 3, if not 4 more interest rate rises this year alone.
Okay. And so from a real estate agent perspective, that's important to me in working with my clients, in that if they're not in the situation and environment we're in right now with a limited amount of inventory, that if the longer that they're taking, and if interest rates continue to go up, it actually constricts the amount of home and that they can purchase, and with
less
the
people
value that they're looking
can purchase that. So let's just take a $450,000 house, which is probably about average in Denver right now, right? So $450,000 house, you've got X number of people that are qualified to purchase that house, that are looking to buy a house. Now, if rates go up, less people are going to qualify for a $450,000 house. Somebody that qualified for $450,000 last week, maybe they only qualify for $430,000 this week or something like that. So you've got less competition for that price, which inevitably, in my opinion, means you're going to have to start seeing price values come down a little bit to meet that same demand. Now, we're in an environment where there is a ton of demand. So that may not equal out for a little while. It actually, could be a really good opportunity for some buyers to find that house and get into a house that they've been trying to. A little less competition for them.
Right.
Would you agree? Maybe.
It remains to be seen. If I knew that, I would be in Vegas right now and not selling real estate. But let me touch also on the other point that you made about the Fed raising the interest rates too. So that has an indirect impact. So you hear that a lot. And people start going, the interest rates are going. It's not all interest rates are going. The Fed interest rates, which impacts
it's
other
the Fed
markets, and then it has impacts on the bonds and
so it's the Fed funds rate, which is the amount that banks charge each other to borrow money. For overnight borrowing of money from bank to bank. It's relatively complicated. I'm sure you can Google it and read all about it. But what it means kind of for us from a mortgage rate is that usually mortgage rates are going to follow suit. When the Fed raises the Fed funds rate, typically mortgage rates will follow suit.
Gotcha.
So, don't get too excited when the Fed says they're raising rates, but understand that it could very well mean a rise in mortgage rates.
I've seen it go the other way.
Right.
Because
the market itself has already taken
years.
A lot of times the market itself has already taken into consideration the increase of an interest rate. Like we're in that kind of environment now. So they may raise rates next month, but the interest rates may not adjust directly
Right.
with that because they've already taken it into consideration. Right. It's already part of the interest rate today. That's
it.
Topic.
Now that we've confused everybody about that and told you to go Google it because we have no idea how to explain it very succinctly. Let's continue.
Perfect. So how do you determine what an interest rate will be? So what I've done here is just kind of broken down. I pulled up my rate sheet. I looked at all the different things that could impact the interest rate. And probably more specifically, I've looked at all the things that can impact the price of an interest rate. So each interest rate has a price. Either you, the borrower, is paying for it, or we as the lender is paying for that interest rate. This is confusing. You're not the only one confused by it. But let's talk about some of the things that might impact what the cost is for an interest rate. So your credit score. The better your credit score, typically the less cost you're going to have for a particular interest rate.
Okay. Why is that?
Try to keep it simple.
Why?
Because a better credit score, according to the credit agencies as well as the lenders, they believe if you have a better credit score, you are less likely to default on the loan.
So there's a lower risk.
Lower risk.
Gotcha.
You got it. This is really small, huh? Loan to value. So loan amount divided by the value of the property, or in a lot of cases, the purchase price. So this is typically going to be higher. Typically, the higher the loan to value, the higher the cost for the rate. So in other words, if you have a higher loan to value, maybe 95%, 97%, 90%, the closer you get to that 100 mark, the more it's going to cost to have the same rate.
Because of
higher risk.
You
got
it. so basically, they're determining on an ongoing basis how much of a risk you are as a borrower, and the less of a risk you are, the better
These are all
interest rates
risk
you're going to
factors.
get, and the higher risk you are, the low, the higher it's going to be.
Yep, they're all risk factors. So what does that mean? It means you benefit more from a rate standpoint, or at least the cost for the rate, the more you put down on the home. Cash out. So if the borrower, this doesn't really apply to purchasing a home, but it does apply to refinancing a home. If you're refinancing your home and you're taking cash out, that's considered more risky. So, you go to refinance, you have $100,000 balance, but you then decide you want to take out $50,000 more. So now you have $150,000. Just the fact that you're taking cash out, your own equity, creates a higher risk.
Yep.
High balance. So in Denver County and most of the surrounding counties, the high loan limit for conventional FHA VA financing is $453,100. If your loan amount is higher than that, and you can go to $529,000, so if it's somewhere in that range, that's considered high balance, and there's going to be an additional cost for the rate on that. A little bit more risk, right? Higher loan amount, more money to pay back.
Yep.
Better chance of default.
That's what the lender, that's what the underwriters, that's what they're all looking at.
Yep.
Is balancing that risk.
Yep. What's next on here? Subordinate financing. So if you're purchasing a home, or even doing a refinance on a home, and somehow there's a second mortgage involved. So a home equity line of credit would be a good example of a second mortgage. If that's involved in the transaction, there could be an additional cost for your rate on the first mortgage that you're refinancing or the home that you're purchasing.
So are you seeing a lot of subordinating financing
Nope.
these days? I mean,
Not
it was
much.
really big about 10 years ago.
It was very big about 10 years ago. It is an option once you start to get over the 529,000 range and you get into jumbo territory. Some people like to, instead of doing a jumbo loan, do a conventional loan up to that 529 and then have a second mortgage behind it. So that's fairly common, but we don't see a ton of it.
Okay.
Occupancy type. So primary residence. Are you going to live there? That's less risky than if it's a second home or an investment property. So just because it's an investment property or a second home, there could be some more costs for that interest rate.
Yep.
Let's see. Multi-unit. So in residential lending, we can lend up to a property that has 1 to 4 units. So it might be even like a condo complex with 4 units in it. You could buy all 4 units, but the more units, the higher the cost is for the rate.
Yep.
Loan amount. So this can apply across the board. So typically loan amounts less than 100,000, less than 75,000. There's an additional cost for that. The same can apply for like VA loans. The higher the loan amount, the additional cost there is for that. So keep that in mind. Borrower or co-borrower with no FICO scores. So in some cases, lenders could do a loan where the borrower or possibly the co-borrower does not have any credit scores. Well, that's a risk. I mean, credit scores in and of themselves tell the lender, what are the odds that you're going to be able to pay this thing back? What's your track record or your history with credit?
Right.
Well, if you don't have any, they don't know.
So you kind of think, and I've run into this often with people who are very, let's say, financially conservative about not having credit, paying cash for everything.
Yeah.
And they're looking for a mortgage and they have no history.
Yeah.
And a lender says, yeah, well, we have no way to determine whether or not you're a high risk or a low risk. So then what do they do? What can they do?
There are some loans that allow you to do the loan without having credit scores.
Okay.
There's also what they call alternative trade lines. So we may verify that you've been making your cell phone payment over the last year, your XL Energy payment over the last year, car insurance, those kinds of things. Sometimes we can use what they call alternative trade lines and be able to get it to work that way.
And so if you're doing a loan like that, there's alternative trade lines. Is that more expensive? Is that going to be more expensive, have a higher interest rate?
It can be, but it doesn't necessarily mean that it will be.
And so if
somebody's some other variables into account.
So if somebody's watching this and they're relating to the fact that they pay cash and they're thinking about buying a home, what can they do now to start setting themselves up for success in the next 6 months, 12 months, where they have no trade lines?
The more money you put down, the better that loan is going to end up being.
Save
more money than you otherwise might.
What about getting a credit card? And maybe
I would say,
buy a cup of coffee on it.
I hate to encourage people to get credit if they don't want to and they haven't conducted their financial lives that way up to this point. The reality is that in a lot of cases, lenders want to see credit scores. And so you don't have to, but I think in a lot of cases you have to sort of play the credit game,
right?
Which would be, go out and get a credit card or two.
I'm not saying go buy a Maserati.
No. What I would say is go get a couple of credit cards, use it once or twice a month, pay it off every month.
Right.
At least that way you're establishing a couple of trade lines, and that will help you to build and establish some credit scores.
Cool.
So, escrow waiver. So escrows are your taxes and your insurance. So most lenders, and on some loans they're required, on other loans they're not required, but lenders like to collect that money and hold it for you for a couple of different reasons. They probably make interest off of those funds as they hold them. Mm-hmm. They also know that they're going to be able to pay the taxes on time and pay the insurance on time. And that takes that out of your hands. Well, when you do that, it's less risk. Exactly. The lenders, if you don't escrow through the lender, there's typically a little bit higher cost. Okay. And the last one I have on here is condominium. So if you are purchasing a home and it's a conventional loan, then it's a condominium, typically you're going to have some additional costs there. Not always. Usually if you're putting more than 25% down, that's not going to have an impact.
Why is that?
So condos, you're not really the only one buying a condo in a sense. Mm-hmm. You're joining an HOA, a homeowner association, right? So they have a direct interest in your ownership in your condo or your home. And so a lot can go wrong.
Owning the space in the air that you are living in.
Yeah.
And you all own a piece of that space in the air.
You don't control and own it like you do a single family residence. Okay. Where nobody else really has much of an interest. I mean, you could make an argument that planned unit development has a little bit of a hold on your house, but a condo, you're very dependent on that HOA, and quite frankly, the performance of the HOA. Are people making their payments to the HOA? Are they not delinquent? If enough people are delinquent on the HOA, that's a real big problem for those that are making the payments. You have to make up for those lost delinquencies. So we can go on and on about that, but
greater risk.
Greater risk. You got it. So how does your interest rate impact your loan? And we've talked about it before. The higher the interest rate, the higher your payment, and the more you will pay in interest over the life of the loan. The opposite of that is true. The lower your interest rate, the lower your payment, and the less you will pay in interest over the life of the loan.
Yep.
So a simple concept, but one that you really need to understand. You can buy down the interest rate through discount points. So by paying however much it is that day, maybe it's half a percentage point, maybe it's a full percentage point. You can buy down in increments of 0.125 or eighths of a point.
Okay.
So where the par interest rate that day might be, let's say 4.75%. You might say, I'd like to buy that down to 4.5, 4.375.
What's the benefit of that?
So the benefit is the lower interest rate. Yes, you're paying more up front, but over the life of the loan, you're going to end up saving money on that because of the lower interest rate and the less amount of interest you'll pay over the life.
And are you talking tens of thousands of dollars to buy down?
Could be over
rates?
a 30-year period. Oh, to buy down the rates? Probably not that much. I mean, it's really up to you. A lender will let you buy down. If you're at 4.75, you can buy down to 3.75 if you want to, or lower. But it gets to the point where it doesn't make sense anymore.
Right. Okay.
So
it's a personal preference.
I mean, if you're like, hey, I'm only going to live here for a few years.
The payment to be, or if you don't want to pay as much over life of the loan.
If you buy down the rate, your payment's going to be lower each
Right.
month, and you'll pay less over the life of the loan, but you'll have paid more money up front for that interest rate.
So, okay, one last thing. So that, again, is where it's really important for somebody to come in, sit down with you and say, hey, I've got X dollar amount for down payments.
Yes.
Should I use that towards down payments, or should I use part of that for down payment, part of that for buying down
Closing
the rates?
costs, discount
Closing costs. What is
Yep.
it? What is the best scenario for me to save the most amount of money based upon what my situation is?
Right.
Because sometimes people come in and they just really don't have any idea. I've got
Yep.
X dollar amount and I'm going to put it towards down payment.
Yep.
That might not make sense.
Yep, I would agree. So the opposite of that is true. You can also accept a higher interest rate and have the lender give you money to use towards your closing costs and prepaid items. So instead of taking that 4.75% and buying down the rate, you might say, hey, I'm willing to take a higher rate with a higher payment, and the lender is going to cover my closing costs. It may not be all the closing costs. It might just be a portion, and that may be dependent on how much money you have to work with for the transaction. But sometimes people are cash strapped, or they just don't want to use their funds. They're okay with the higher payment, and they say, why don't you guys pay the closing costs? And as long as the numbers work out, we can do it.
Right.
All right. So moving along here. Are interest rates negotiable? So they can be. It's worth asking the lender, is this the best interest rate that you can provide? I will tell you there's not a lot of room to wiggle in most cases. I've worked for a couple of different lending institutions right now. Most lenders cannot just adjust their price because you asked.
Well, let's be clear. You don't wake up in the morning and say, I think I'd like interest rates to be X.
I have zero control over interest rates.
So even the lenders,
Right.
No, I mean it's all based upon a set formula from the market,
a much more macro economic.
And so
Yeah.
you do have some very small abilities to, not you, but your company,
We have
to move those in one direction or the other, but not like.
And that's sort of on a daily basis. Sort of depends on where we are at financially as a company. But we can ask. Here's the thing: you can't just say, "Hey, I want a lower rate," because the rates that we have are for everybody across the board. If we were to give one person one rate and another person a different rate, it's discriminatory, and we're very heavily regulated. So we have to keep that in mind. Now, if you were looking at shopping your current bank against us or something like that, and you provided us with, here's all their costs, here's their rate, we look it over, we're like, yeah, it is a little bit of a better offer. Then we can take that and say, hey, here's what the other offer is. Can we at least meet this?
Try to compete.
Yep.
Well,
so
and
it's
so
worth asking.
You also made another great point, which is that the rates move every day. And not because you're changing them, because of the market.
Right.
And the market changes, so they go up, they go down hourly, and that changes, and so that has an impact
Yeah.
on it also.
And it's such a competitive marketplace that no lender is like all that much higher, all
Right.
that much lower than the guy next door.
Right.
What you really want to make sure is that you're working with an experienced lender that's actually going to get you to the closing table and not lose your earnest money.
Right. Well, and we're not going to go into detail
No.
today about all the things that, people talk a lot about rates and when am I going to lock them and what is
Yep.
it today? Should I wait? Should I do it? Da, 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 da. And sometimes that's just doesn't make sense.
Yep.
But
I would
that's a
agree.
whole nother show. Maybe
That's
we'll
a whole
talk
nother
about it,
show.
okay? Put that on the list.
So to recap, so interest rates can have an impact on your mortgage, both short and long term, positive, negative, higher, lower, and interest rates change every day. So there's a lot that goes into an interest rate, and it is very important to remember that interest rates can change daily. So we went through that list
Mhm.
of things that can impact the cost or directly the interest rate itself for a particular loan. So when somebody asks, as a lender, when somebody asks me what's the interest rate today, that's like oh geez. There's a lot that goes into
At
the
this
answer to
minute,
that
right
question.
now,
Yeah.
based upon like perfect
Like,
credit
what's your
or whatever.
situation,
So
you know?
it's
Yeah.
it's an impossible question to answer accurately.
Exactly, without having a whole bunch of information for the client.
Right.
The higher the rate, the higher the payment, and the more you pay in interest.
Yep.
This industry is very competitive and heavily regulated. Prices don't vary all that much from lender to lender.
B-A-R-Y.
Yep, you're right.
They very, very.
It's essential that you are working with an experienced local lender that can get you to the closing table. So
Absolutely.
keep that in mind.
Hey, again, we say it probably every show. Sit down, talk to your lender, talk to your real estate agent, get a game plan together.
Get your team
prior.
together.
Exactly.
Get your team together.
Hey, and then sometimes that's your financial planner too. Sometimes
Yeah.
that's your
Yep.
attorney also
Mhm.
to talk
CPA.
about what your CPA, what's your macro situation is, and what is the most effective way to
Yep.
move forward. So awesome! I think that was a lot of information. Took a little bit
A
long,
ton.
but
Yep.
the interesting thing is I get questions all the time if they say, well, what lender I talk to, where am I going to get the best rate? Do I go to
Right.
Quicken Loans online or talk
Right.
to John or who? It's like,
Yep.
that is a huge question. Sit
Mhm.
down, let's pull somebody in, let's pull John in, let's talk about it. And so hopefully that helps a lot of you. If you have further questions, this is our contact information right here. John, how do we get a hold of you if we want to know what the interest is right now?
What the interest rate is right now with no additional information. 303-921-5747.
All right. And Jude at judesandoval.com, 720-427-1021. Just again, if you found some value in this, please like us, share.
Subscribe to Jude's
Subscribe
YouTube
to my
channel.
YouTube channel. Bump me up to 3 people. Let's try to double it. Go all the way to 4. John, you got your YouTube up yet?
I have my personal one,
Your personal?
but it's
Okay.
Lacking.
Well,
in
so go watch and look
updated-
at John's cute little kids. Subscribe and see
Yeah.
some more videos from his little kids and help to support his family by contacting us for a loan. So,
All right,
we'll
thanks
see you
everybody.
next week.
See you next week.